Hello and
Hello and
welcome to
welcome.
Growth Dialogues. It is an initiative of the Center for Digital Economy Policy Research, which focuses on discussions on how we can further accelerate the stupendous growth that India is going through. We are fortunate to have today as one of our guests, Mr. Anirudh Tewari. He is the Director General of Mahatma Gandhi State Institute of Public Administration at Punjab, and he was the former Chief Secretary of Punjab. Mr. Tiwari and I met way back in around 2015 when the Punjab investment promotion was going on, and Mr. Tiwari was being looked at as a super bureaucrat who was helping out all the private sector in the investments into Punjab through innovative mechanisms such as single window clearance, which was not just a name and not just a label, but was an actual single window clearance happening under one single building. There was literally one window, if one physical window that was clearing off all the investments. So I'm very fortunate that Mr. Tiwari agreed to take out time and have this conversation. Welcome, Mr. Anirudh Tiwari.
Thank you, Jaijit. Thank you so much. And thank you for this very kind introduction. And good evening to you and good evening to all your listeners.
Thank you. So, Mr. Tiwari, very recently you wrote an article on what needs to be changed with the Finance Commission. And given the large experience that you have had at the state level, and it's the fact that the states are really the engines of growth, and many of the states are not growing as fast as some of the other states are, which brings down the average growth rate of this country. What was the crux of this article that you wrote, and how do you think we should be able to further accelerate the growth that India is growing through?
Thanks, Jaijit. We are a union of states, and the arrangement between the union and the union government and the states really has been defined very clearly and anchored in the constitution. If the parts do well, the whole does. And to my mind, the states really have to create institutions, policies, and environment which really spurs growth. So that as a whole we grow together. I recall, concluding that article saying that there can be no weak link and nobody can be left behind. That's the way we should be looking at the union. Now, certainly there are certain actions which lie in the domain of the government of India to spur this growth. There are certain policies, for example, if it is policy related to bring in FDI, if it is related to trade liberalization, all these things, all the exchange rate issues, foreign aid, etc. These are in the domain of the government of India. But there are certain policy actions, there are certain initiatives which lie with the states. For example, creating policies to promote export-oriented industries, or offloading your loss-making PSUs and unlocking the assets. But most importantly, the way I would look at is the development of human capital. That is something that really lies in the hands of the states. Education is in the concurrent list. We do have NEP 2020, but then the states really have to do a lot of work. Similarly, health, it's a state subject, but these are areas where the states can contribute a lot. And I would also look at some of the services industry like tourism and, of course, building infrastructure. But what is happening is that building infrastructure is proving to be a bit of challenge for the states. And the reason for that really is because of the resource constraint that most of these states are facing. What the way I would like to kind of sum up here is that the states, if you were to look at what is required of the states, it is to build that human capital, build that infrastructure, put in policies that facilitates the development of enterprise. It's not only about facilitating the big industry, but making sure that it is easy to do business for even small businesses, the MSMEs. For example, MSMEs are really the backbone of industry in a state like Punjab. We have to ensure that they are facilitated, because they are the ones who are going to create jobs. They are the ones who are going to create, contribute to your growth. Of course, there are challenges as well. The first one I see is in the sector of education. Last week I was in a conference here in Delhi where I met with some of the directors of IITs, IIMs, many vice chancellors, and everybody was lamenting the lack of trained faculty. I mean, the faculty for these education institutions is not available. That's a huge challenge for our country. I mean, if we are no teachers, what are we going to do? I mean, of course, infrastructure itself is a challenge. We are looking at building schools, building colleges, building universities. But ever since the private sector has been encouraged in the higher education segment, that part is to some extent taken care of. But where is the faculty? Where are the people? Where are the doctors to run the medical colleges, to teach those students? Where are the paramedics, the radiographers, the lab technicians? That I think is something that we really have to plan out. I do recall, you mentioned my days in West Punjab, and when one would talk to the industry in what we could do or what are the challenges that they were facing. And one of the challenges that they would highlight is human resource. And, all other factors remaining the same, industry really looks at a place positively if you have a good trained human resource available. As one investor was telling me, he cannot, trust a fresh graduate engineer these days with his new machines, which is worth a couple of millions. Now, the quality of people, the quality of human resource that we are getting, they are in turn going to be extremely important. We are looking at cutting edge technologies, 5G, AI, robotics, but we really need to make sure that the industry really has people who are trained in these domains to be available for contributing to the growth segment. As I mentioned, I mean, in building infrastructure, states are lacking that fiscal space. The states are lacking that. The states are facing a problem, and this is true for most of the states. I think, except for perhaps Maharashtra and Gujarat and perhaps UP, Odisha, others are running huge revenue deficits, and fiscal deficits are going beyond the roof. Of course, the disruptions caused by COVID have contributed to it, but what it has also meant is that the debt profile of most of the states. We talked about this issue of debt profile in one of our previous articles, that the debt GDP ratio of many of these states is really getting into an unmanageable kind of a situation. Ideally speaking, as a country, we should be aiming at a debt GDP ratio of 60% or around that. Some people may say that even currently at 87%, we are not, in a very serious situation, given the position that some of the European countries are, or even the BRICS nations are. But what I would see is that the fact that we have been able to weather the storm because of some certain strong macroeconomic fundamentals does not mean that we let the guard down. I would really look at situations where the union is at about 40% of debt GDP ratio. The states are at collectively at about 20% today. Most of these states are either 30 or even beyond that. The worst case is, of course, states like Punjab, Kerala, and even Tamil Nadu is going close to 40 now. So we need to get our debt GSDP ratio under control, because what it does is that if the government is going to be borrowing heavily, it has a huge impact on the debt markets. It leads to a rise in interest rates and really leads to a crowding out of the private investment. And once we are in that kind of a situation, I see that we are really getting into troubled waters. So what I would really look at is getting our debt GSDP ratio under control, And as a country, we came out with this interesting, for the country, we came out with this interesting concept called the 448 triad. What it really suggests is that overall, we should be looking at 4% fiscal deficit for the country as a whole, a 2.5% for the union, and about 1.5% for the states. Going into 2031-32, and we expect the RBI to control inflation and get it close to 4% through its monetary policy interventions, and a growth rate of 8%. That is something that, this 448 triad, to my mind, is something that could really take us to the target of getting our economy to $35 trillion by 2049 to 2047, the Amrit Kal area that we are looking at. On the other side, once you have the debt GSTP under control for the states, which means that the states are not spending a lot on debt repayments and interest repayments. Many states are now doing it above 20% of their revenue receipts, which is not a very happy situation. Punjab is doing it beyond 20%. What it does is, the moment it brings down that cost of debt for the states, it frees up resources that are then available to the states to invest in both social infrastructure and in physical infrastructure. That, to my mind, is something that the states should be looking at. Bring their revenue deficits under control, and make sure that they do not increase their revenue expenditure beyond a particular point. That, to my mind, is something that the state should be looking at to kind of spur the growth that we are looking at as a union.
So while we were discussing, there are a few questions that have started coming in from our viewers. So let me ask one which is quite interesting. And the question is that, does an absolute debt to GSDP ratio really matter? Or is it the quality of the debt that matters? Because, we see countries globally with 200% debt to GDP ratio, and they're still chugging along. They're one of the most powerful countries. And the response truly is that it depends on the quality of debt. So is that the real problem, or just fundamentally the absolute debt to GSDP is also an issue?
To some extent, it is correct that we can't only just look at the absolute numbers. We also have to look at the composition, the quality of debt. But as far as the states are concerned, I think what is happening is that the states are incurring debt, which is their ability to raise debt is very limited. They are mandated under Article 293 of the Constitution to approach the markets only through the union. We, in fact, have been advocating for consolidating the national debt itself, because we see a lot of advantages in consolidating the national debt, so that the states do not approach the market individually, because we do not really see much advantage in having a fragmented market for the states' debt. But what is also doing is the quality of expenditure that is happening thereafter. Now, the point that I mentioned earlier was that these huge revenue deficits that are building up, they leave a little scope for the states to spend the debt that they are incurring on building quality infrastructure, which in turn would lead to growth. That is something that is a cause of concern for us. The revenue deficit to the fiscal deficit ratio is something that is a cause of concern. Most of these states are, high on revenue deficits. I wish the revenue deficit was also just for creating health and building at least social infrastructure, if not physical. But that's also not happening. What we are seeing is a lot of expenditure happening on committed areas. Whether it is debt servicing, salaries, pensions, and of course, the subsidy bill of most of the states is also rising for a lot of variety of reasons, whether it's the farm loans or whether it is the power subsidies. A lot of expenditure is happening there, which in turn is increasing the revenue deficit. So that quality of expenditure also is causing a lot of concern.
So, this brings us to one of the points that you are mentioning in your article about non-tax revenues. And that's an interesting aspect. And over a period of time, the non-tax revenue has been going up. And as at the Center for Digital Economy Policy Research, we had written that government is essentially a business of monopoly, and therefore many of the services are essentially monopolistic. Along with it, when digital comes in, there are many services that only the government can provide and nobody else can. So, are there any thoughts at the state level to increase non tax revenue generation using new kinds of mechanisms, new kind of services to the citizen, which is a win win situation for both?
Yeah, you're absolutely right. After the GST has come in, actually, there are very few items that are, that give flexibility for a state government to raise resources. Uh, to my mind, I mean, whether it's just the state excise or something on transport. Uh, though those are the electricity duty. Those are a couple of items, or the VAT on petroleum. Those are the couple of items that are left in the domain of the states, and the rest has really gone to the GST Council. So, to that extent, the flexibility has reduced after the GST has come in. But the point here is that many states have actually looked at non-tax revenue and have increased it also, especially those states which have access to mining resources. But I agree with you that there's a lot left, that can be done, and the states really should be focusing on raising their non-tax revenue. And the simple reason is that please recover the cost of providing those services, especially once you are in a situation where you are the only provider of those services. But most of the time, political considerations have come in, even as small matters as hiking the rate of the parchi fees in a government hospital. Now, over a period of time, hospitals have complained, that they lack resources for regular maintenance, for regular, supply of medicines, etc. So some states have innovated and allowed flexibility in expenditure by allowing the hospital itself to retain those revenues. Although I personally have never been in favor of fragmenting the resources of the consolidated fund of a state. Inefficiencies in treasury management cannot be handled through a fragmentation of the consolidated fund. That is not something that I would advocate. But what is happening is that in that sense, the non-tax revenues have not gone up. States have not really exploited the urbanization that is happening. You see, urbanization, which is coming in, also can prove to be a huge source of non-tax revenue for the states. Whether it is a change of land use or other areas. Mining royalties have not been exploited to the same extent. And another area, to my mind, also is for looking at recovering the costs of digital services. The states have moved on to digital governance, but many states are not even recovering the cost of those services after making the investments. Somehow that's something which I agree with you. The state should be looking at increasing their non-tax revenues. The government of India has been increasing its non-tax revenues, and they have been going up. But the states have done little to augment that resource.
So while we were speaking, one of the questions that came in from one of our viewers is on your urbanization point, that a lot of Punjabi youth are leaving Punjab for Canada. And that's possibly one of the reasons could be lack of urbanization. Can the private sector be roped in for increasing the rate at which urbanization is happening in Punjab?
Jaijit, I would say that the reason that Punjabi youth are leaving for Canada and other countries, I would not put it solely on urbanization. Of course, everybody wants to look at better opportunities. What it really underlines is that perhaps sufficient opportunities not available at home to retain them here. That to my mind would be the way to look at things. And I think successive governments have tried hard to bring in industry. That has been, the lack of a strong manufacturing sector in Punjab has been felt over the last couple of decades. Second is the post the Green Revolution, there has been a stagnation in the incomes of the farmers. Not many opportunities are available for the youth outside agriculture. Agriculture, unfortunately, is not growing at the level that it should. And that is, I would say, a topic for another discussion, where I would say that if the country has to consistently clock 9.5% to reach that figure of $35 trillion, agriculture cannot grow at the rate at which it is growing. That is something that we have to be very seriously look at as a country. But for the youth of Punjab, I would say that it is the opportunities, the current opportunities at home that are not strong enough to retain the youth here, and people are looking at better opportunities abroad.
Right. Yeah. No, also the fact that in agriculture we already have too many people, that's also causing distress. We need to have more people, less people doing more agriculture. Also reminds me, Mr. Tiwari, of your and my effort to look for a 200-acre contiguous land for one of the pharma companies, if you recollect. And at the end of it, we both gave up and they went to some other state. The question is that can states like Punjab, which have pressure from agriculturists, they got significant land pressure, land is expensive. How will you manage to attract industry with such challenges in hand?
You see, I mean, it is correct. I mean, getting land in Punjab is not easy, because every single inch of land is generating wealth for the owner, whether it is agricultural wealth or it is a part of an urban landscape. So every single inch is valuable. It is unlike many other states where probably you have huge tracts of land which are like useless, they have little economic value. But in Punjab, each square inch of land has an economic value. It is a challenge to find land. But nonetheless, if we want to get industry, we would have to make sure that land is available at a reasonable cost. And more than the cost, I would say, because if you see ultimately in the big scheme of things, the component of land is not really too much for the industry, the cost component. But what is important is the ease with which that land can be made available to the investor. And what my experience tells me is that there are, apart from land, the other factors that really attract the investor to a particular place, apart from the classic ones of availability of raw materials or the markets, close proximity to a port, are ease of doing business and availability of human resource. If you have good human resource available, if you have an environment where this human resource that you may import from elsewhere also is willing to stay, that is something that attracts investor. And secondly, how easy and how facilitative is the government to that investor. We had our own experience. Punjab has over the years built a very, very robust system of attracting investors. It has been successfully running. This government has also been doing a lot. Even yesterday I was reading that a Netherlands-based company is putting in a huge investment in Punjab. So investments are flowing in Punjab also currently also, and I'm sure in the years to come also taking advantage of the institutional mechanism that we have been able to develop and set up, investors will continue to look at Punjab as an attractive destination.
Sure. I'll switch the question back to your article on the Finance Commission's change in focus. One of the questions I had based on your article, which talked about state PSUs, rather PSUs generating revenue for the central government. So the question is, why can't the state PSUs do the same? Why can't their efficiency be increased? And why can't we do asset recycling at a state level, the way it's happening at a central government level? And clearly some of the states are doing it, but it's not as widespread as it is at the central government level.
Jaijit, I have a couple of thoughts on this. The first is if I may use a very strong one, it's not the government's business to be in business. So there are certain areas which are best left to the private sector to handle. I mean, for example, tourism, transport. These are best, the efficiencies of the private sector need to kick in into these sectors. And wherever the states are still present in these sectors, they need to kind of phase themselves out of these sectors and make sure that they unlock the assets. For example, I know tourism development corporations of many states are sitting on fantastic assets. I mean, if you were to actually give them to the private sector, they would generate so much of wealth out of it, make tourism such a attractive, make those properties so much attractive for the tourists to visit. So that's one. The second is, again, the classic problem of managing a public sector, which is the inefficiencies. They're not run professionally. There's a lack of accountability. They are, I do recall having this conversation once with the chief minister, where I said that and I was at that point in the state electricity board, I said that you have to decide whether you want to run this as a commercial entity or you want to run this as a government department. If you want to run it as a government department, please don't expect commercial results out of it. But if you want commercial results, allow this entity to run as a commercial entity. We have seen that some of the states which have managed to run their PSUs professionally. Gujarat is one state which has been doing it consistently, whether it is natural resources or even asset management. They have been doing fantastically well. There are certain other states also which have been doing well. Tamil Nadu has done has been running its PSUs very well. So some of these states, Karnataka road transport did very well for a long time. So we need to make sure that these PSUs are run professionally. They are held accountable, and there are a lot of occasions when political appointees are there on the boards of these corporations. Their role has to be minimal without compromising on the efficiency or the profitability of these PSUs. And certainly, I would say that it is only in some of these areas that the government still needs to be present. Otherwise, I would say that please phase them out to the private sector and let us, as a nation, get the efficiencies out of the private sector as much as we can.
Can't agree more with you on that. Absolutely. So I'm almost out of time for this podcast, but there's one last question I would like to ask you, again, based on the article that you wrote, which is a very erudite article that you and Mr. Karan Singh had written. The question essentially is, what is your high-level view of what the 16th Finance Commission should be focusing on, and perhaps what it may want to focus on in addition to its traditional way of actually distributing the funds from the central government to the state governments?
You see, Finance Commission has a very, very important role in our scheme of things. I mean, it's part of the Constitution. And if you look at the Constitution Assembly debates, it's very interesting to read the role of the Finance Commission. To our mind, and what I feel the 16th Finance Commission really should be looking at, and we gave the title that an opportunity to phase out the moral hazard. I mean, what I feel is that there is a moral hazard with the state government, with the states, and the moral hazard with the union. Now, for the union, the issue is that because the Finance Commission is only looking at the net proceeds of taxes in the divisible pool, and you'll be surprised to know that currently the divisible pool is only 68% of the gross revenue receipts of the union, and states have been arguing that the entire gross revenue receipts should be made part of the divisible pool, and we tend to agree with that, because what it does is two things. One, it brings in transparency. So as far as the entire world is concerned, there is a particular pool that is created by the government of India, that is then divided as per the formula given by the Finance Commission between the states and the union. But the second point is that if we keep certain revenue resources out of the divisible pool, a lot of times the governments have a tendency to raise resources from avenues which are outside the divisible pool. So, what happens is that many times you impose a suitable tax rather than the right tax. That's the way I would like to put it. So, if the gross revenue receipts were to be part of the divisible pool, this moral hazard would not exist for the union government. On the part of the states, what is happening is that the states have realized that every finance commission is a new finance commission. There is hardly any institutional memory left. Even if they have committed a fiscal consolidation path to the previous finance commission, it is hardly taken into account by the successive by the successor, and they can merrily again project their fiscal consolidation path and get a revenue deficit grant out of if they are able to advocate, hire have a good advocate for their case. These days people are even looking at professionals to present their case to the finance commissions. That to my mind is a huge moral hazard on the part of the states, that they have not been able to stick to their path of fiscal consolidation. What we have advocated in our paper is that the formula needs to be a two-part formula. One is a fixed component, the other is a variable component, and the variable component has to be based on the compliance of the state to that fiscal consolidation path that it has committed to before the finance commission. That is something. Otherwise, that pool, the 25% resource, 75% gets on the fixed path, fixed component, and 25% is the variable component. Otherwise, somebody else would get that. Only when you have this kind of a competitive component where the state has to perform in order to get its share out of that 25% pool, would you have states consolidating. Otherwise, the states could continue to be to follow a path where they'll run huge fiscal deficits. Revenue deficits would be huge, looking at revenue deficit grants. And as they say, the chain is as strong as it's the weakest link. You cannot have a weak link in the union of states, which has an impact on the growth that you are looking at to reach that figure of $35 trillion by 2047.
Right. Now, I think that's pretty much sounds like comparative federalism, and we need to have competition in order to have growth. Absolutely agree with you. And as usual, it's an extremely enlightening experience to have a conversation with you. And same was the case today. I hope this is of significant value to policymakers and to students of public policy. I completely enjoyed having this conversation, learned a lot as usual. Thank you so much, Mr. Tewari, to be part of this show and of this India Growth Dialogues, and look forward to having a continued conversation with you.
Thank you, Jaijit, for giving this opportunity. Thank you so much.
Thank you.